Hi, I'm Richard Vague with Tycos. Interest rates are high by recent standards, and elected officials are bemoaning the high interest cost on government debt. But for every expense, there's an offsetting income, so the government's pain is someone else's gain. So who are the winners? Well, over the last 2 years, as interest rates have increased sharply, the biggest winners of all have been the wealthiest households. The top 10% own a lot of government bonds, corporate bonds, and bank CDs, and they've made out like bandits, perhaps by as much as $150 billion in this period, and that is translated into increased household spending. That amount includes the benefit to pensions, mutual funds, and insurance. So who else wins? Foreign entities, the foreign governments, corporations, and households that hold U.S. government and corporate bonds. Unfortunately, with our huge trade deficit, we are net borrowers from the rest of the world, so they too are getting paid handsomely at our expense. Remember, it's a zero-sum game. So the government's painfully high interest expense is helping the wealthy and foreign entities. Kind of makes you want the Fed to lower rates, doesn't it? So who are the big losers? The government, of course, whose net interest expense grew $150 billion higher in 2023 as compared to 2021. And ironically, another big loser is the Federal Reserve itself, which sets interest rates and which posted a loss of $132 billion in 2023, down from nearly $3 billion in profit in 2021, a period in which, by the way, its net worth declined from a positive $142 billion to a negative $931 billion. So those are the biggest winners and losers, but let's look at the other key sectors. Financial institutions are winners to the tune of roughly $125 billion, most of which was in banks, which earns $70 billion more in net interest income, but that was largely offset by lower non-interest income and a rise in loan loss provisions. The bottom 90% of households didn't do all that bad. It has been roughly a push for them, and that's why the Fed's high interest rates have not yet caused a recession. The reason for that is, the reason it hasn't been more negative, is that most homeowners have fixed-rate mortgages. Hypothetically, if all household mortgages had been adjustable rate and had been repriced to the miserable 2023 variable rate of 6.44%, they would have plummeted in net interest income an additional $740 billion in interest payments. For an individual with a variable rate loan and a $320,000 mortgage, the average monthly payment has increased from around $1,300 in 2020 to $2,100 now, a 62% or $800 a month increase in just interest expense. But again, most have fixed rate mortgages, so they've avoided that. What about businesses? Non-financial businesses have been feeling the weight of higher rates too. This can hinder investment, hiring, and other items such as dividend payments. But with this, in order to offset these effects, businesses have had to increase prices to service the rising cost of their debt, which has put upward pressure on inflation, further impacting consumers, which of course is the very opposite of what the Fed intends. Note that we rely here on the Fed's balance sheet data for non-financial businesses for this particular calculation. Why is the Fed keeping interest rates high? Well, to combat inflation ostensibly, targeting a 2.0% inflation rate as measured by the Personal Consumption Expenditures, PCE, price index. But after peaking at just over 7% a couple of years ago, the PCE inflation rate is now down to 2.7% as of April 2024. In our view, sustained high interest rates are not the best method to push inflation down to 2%, and in fact, are likely making it worse. 45% of CPI is housing-related costs, and high rates make new mortgages more expensive, and also push apartment rents higher, since an apartment owner is going to raise the rent on their tenants if the interest rate on their loan to buy the place in the first place went up. Just to give you context, here's a look at the different rates from 2020 to 2023. Fed funds rate went from 0.09% to 5.33%. The primary bank lending rate has gone from 3.25 to 8.5%. Treasury bonds from 1.67% to 5.11%. Mortgage rates from 2.7 to 6.66%, and corporate bonds from 2 to 5%. Now, a note of caution. We believe the analysis we show here is largely and directionally true, but we've had to make some assumptions, which we believe were reasonable, but would note there simply isn't complete enough data anywhere to know the impact of high interest rates with greater precision. So if you have a different or better view on any of this, we'd love to hear from you. Thank you for joining us in this analysis of the latest Fed rate impact. If you found this episode insightful, join the conversation in the comments below. That's it for this week. Thanks.